करायचं. ओके. हॅलो हॅलो. एक मिनिट, टीम्स वाल्यांना एकदा विचारूयात आपण, आवाज येतोय का. हॅलो, आय एम ऑडिबल. कोण आहेत, दोन पीपल आहेत, कोण आहेत. शैला, एम आय ऑडिबल. करते, टाइप करते. हॅलो. येस, ओके ओके. Like you can unmute yourself and talk also. There's no issue on that part.
Hello?
Ha, yes.
Hello?
Am I audible, Shaila?
Yes, ma'am.
Okay, okay. So we can start the lecture now. Okay.
Yes, ma'am.
हो हो, केलं 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 केलं. So can you close the door a bit? So revise the concepts. We will revise the concept.
Hello?
You were present in yesterday's lecture, right? Can you tell me the law of variable proportion? Till then I'll erase this so we can have a bit revision. The law of variable proportion is for a short period in which input factor, how many factors are variable and how many factors are constant? Only one factor is variable and all other factors are constant. And what impact it brings on the output? The impact it brings is same to the law of diminishing marginal returns, right? So as the total product of units of variable input factor increase, total product increases. Marginal product also increases. Again, when they increase more, what happens? Total product reaches maximum. Marginal product becomes zero. Law of diminishing marginal returns, right? And when again the units of the variable factor increase, the total product becomes decreases and marginal product becomes negative, right? Marginal utility becomes negative when the total utility goes on decreasing, right? Clear on the law of variable proportion? Now we will move to the returns to scale, okay? So in the law of variable proportion, what was happening? Only one variable was changing and other variables were constant, right? Now in the returns to scale, what happens is that all the variables change. No variable is constant. And the returns to scale law is applicable in the long run, right? So what happens? All the variables are changing. And when we change all the variables, what impact it brings on the output, that we will study. What impact it will bring? At first, what will happen? When we increase all the input level, the output will also increase at an increasing rate, right? If we double the inputs, the output will also get double. Like it will increase at a more than the input level, that is increasing rate. The output will increase at an increasing rate. Again, when we increase the inputs, what will happen? The output will again increase. But the marginal change will be constant. And in the third stage, when we increase all the variables, again the total output will increase. But what will happen? The marginal change will become decreasing level. The marginal change will be decreasing. So see, this is the table where we will be discussing. See, there are two factors of production. You can see on the screen, land and labor. Yes, so we are changing both the factors of production, that is land and labor. In the previous example, when we were studying the law of variable proportion, only labor was changing and land was fixed, right? So one factor is variable and other factors are constant. But here in the law of returns to scale, all factors are variable, and this law is that we are studying is for a long run, right? So see, both the factors land and labor are changing. First, land 1 unit, labor 2 units. Then they increase the land to 2, labor to 4. Again it became 3, 6. Then again it increased to 4, 8. So both the factors, the land and labor, are increasing. What impact it is bringing on the total productivity and marginal productivity? Naturally, when we increase the input, the productivity will increase at the start, right? If we increase the amount of raw material, the output increases, right? Naturally, at the start, the total productivity will increase. So it is increasing from 4 to 10 at an increasing rate. You can see 4 directly, it is becoming 10. So the margin is 6 here. The margin is huge at the start only, right? 10, it is becoming 18. Again, the margin is 8. 18, it is becoming 28. The margin is 10. So it is increasing at an increasing rate, right? And then again, what is happening? The total productivity is becoming 38, 48. So at this stage, the marginal productivity is constant, right? 10, 10. The increase is constant. The increase is not greater than the preceding increase, right? Preceding increase was 10. The next increase in the productivity is also 10. So the increase is constant. Previously, when we were seeing, see, 6, 8, the increase was at an increasing rate, right? 6, it is becoming 8. So 8 is more than the previous increase, which is 6, right? So the increase is at an increasing rate. Now the increase is 10, 10, 10. So the increasing rate is constant, right? Right, guys? Previously it was 10, now also 10, now next is also 10. The increase is constant. Now what is happening again when we increase both the factors of production, that is land and labor, 7, 14, 8, 16, 9, 16. The total productivity is increasing, right? But what is happening to the marginal productivity? The marginal productivity is also not negative here. What was happening in the law of diminishing marginal returns or the law of variable proportion? Marginal utility or marginal product was becoming negative. But here it is not becoming negative. It is positive. But what impact it is? Rather than the previous, it is increase is less. Here we increased from 6 to 7, right? But in a positive way, right? You understood the difference between the law of marginal utility, law of variable proportion, and the returns to scale. Law of diminishing marginal returns and law of variable proportion are both same, right? But here, what is happening? The marginal productivity is not becoming negative. It is positive, but it is increasing at a decreasing rate. Got the difference? Siley, got the difference? Yes. So here you know the law of diminishing marginal returns. We studied utility. When the total utility decreases, what happens to the marginal utility? It becomes negative. After the peak point, total utility is decreasing, right? But here what is happening? Is the marginal productivity becoming negative? No, it is becoming, first it is increasing at an increasing rate, then it is constant, and then it is increasing at a decreasing rate. Got it? So we will read this, what they are saying. And what is the main difference between the law of variable proportion and the law of returns to scale? Law of variable proportion is for a short run, Law of returns to scale is for a long run, right? In law of variable proportion, only one factor of input is variable, other factors are constant. In the law of returns to scale, what is happening? All the input factors which will be used in producing the output are variable. Every factor is variable. So what is happening? The scale of production in the law of returns to scale is large, right? Because every factor is increasing. The capital gets doubled, labor gets tripled. So the scale of production, that is large scale production, will happen in which law? Law of variable proportion or returns to scale? Returns to scale, because all factors of production are increasing. Naturally, when the factors or the inputs increase, the output will increase at a larger scale. So it is written as returns to scale because every variable is increasing at a large rate. So the increase is on a scale basis. So we'll see what is the law of returns to scale. It shows the relationship between inputs and outputs in the long period. What we discussed, law of variable proportion is for a short run, returns to scale is for a long run. The change in the quantity of factors of production is called scale. We discussed, right? But all factors of production must be changed multiple times. For example, all factors of production are doubled or tripled. This is done to carry out large scale production. In the long run, we will be producing on a large scale, right? That is logical. In a long run, we will be producing on a large scale. In short run, we cannot produce on a large scale, right? If all the factors are halved or changed to 1/3, it is said that the production is carried out in small scale. Change in the output is called returns. What change it is bringing on the output, that we are calling it as returns. So the law of returns to scale explains the change in the output due to the change in the input in the long run period, right? So change in the input is that all factors of production are changing or only one factor is changing. In the law of returns to scale, all the factors are changing. Factor or inputs are changing. But in the law of variable proportion, only one factor will vary and other factors will remain constant. Now what impact it is bringing on the marginal productivity, we will see this. Explanation, what impact it is bringing, what we saw with the help of the table, what impact it is bringing. As the input increases, the marginal productivity also increases at an increasing rate, and as the input again increases, marginal productivity increases at a constant rate, and then marginal productivity increases at a decreasing rate. So what are increasing, constant and decreasing rate? See, if the input, we'll see this, increasing returns constant returns and decreasing returns. So in increasing returns, what happens? We will be comparing the input, output, input, output, input, output. If the input factors, 4-5 factors are there, increase by double, the output factors increase by thrice, means more than the input factors. Got it? If we double the raw material that we were bringing previously, the output will not increase by double, more than double, that is thrice, 4 times, 5 times, that is what? Increasing rate. More than the input that we have brought, that is called increasing rate. And what is constant return? If we double the input, the output also gets double, constant, right? The increase in both is same, that is constant. And what happens in decreasing rate is that if we double the input, the output becomes less than double. That is, it can become, see what, it can remain the same or increase by half, anything like that. Got it? So got what are increasing returns, constant returns and decreasing returns? Clear? So we will read that impact it is bringing on the marginal utility, right? Marginal productivity. We have marginal utility, marginal product and marginal productivity in various laws, right? For marginal utility and marginal product, they are the same because law of variable proportion and law of diminishing marginal returns are one and the same impact they are bringing, right? But in case of returns to scale, the impact is different. The marginal productivity at start increases at an increasing rate, later at a constant rate, and later at a decreasing rate. See, this law explains the proportional change in the output with respect to proportionate change in the input. The changes in the output are classified in 3 stages: increasing returns to scale, constant returns to scale, and diminishing returns to scale. So, from the above table, all inputs are changed in equal quantities or scale is changed at equal rates. Changes in output can be observed from total and marginal returns, and output changes are identified from the marginal returns. In the beginning, when the inputs are doubled, marginal returns are more than doubled. So what it is? Decreasing returns to scale, constant returns to scale, or increasing returns to scale? When the input are double, the output is more than double. What it is? Increasing, right, Saili? Such a change in the output is called increasing returns. But in the 4th and 5th, output has increased in the same proportion given constant returns. And later, similar inputs are giving diminishing returns, right? See, what impact it is bringing on the output is that returns to scale in the law of returns to scale is for a long run period where all the factors of input change at a larger scale where the scale of production is huge. What impact it brings on the output is that the returns increase at an increasing rate, then they remain constant, and they increase at a decreasing, that is decreasing returns. They will increase but at a decreasing rate or decreasing returns, diminishing rate. See, at first they will be increasing, then they remain constant, and then they are diminishing. In the above diagram, scale or combination of inputs are presented on OX axis and marginal returns on Y axis. Scale of production is on OX axis, right? OY is proportionate returns. As inputs are increased in the first part, marginal return curve is rising. That is, they produce. In the next part, the curve is stable, showing constant returns. Finally, further increase in the input is resulting in decreasing returns, right? So we discussed what are increasing returns to scale, constant returns to scale, and diminishing returns to scale. Your name is Piyush, right? Piyush, right? Piyush, tell me what are increasing returns to scale, constant returns to scale, and diminishing returns to scale? We discussed now. I have not read the theory, but we have discussed it. Ha, input double झाला तर output what impact it will bring on output? More than double, right? Ha, and in constant, if the input increases by double, what will happen to the output? Ha, constant. When the change is constant, means the increase is same, right? And in the decreasing returns to scale, what impact it will bring if the input is double? More than double, less than double, constant? Ha. So we will read this now. Increasing returns to scale. if the proportionate increase in the output is more than the proportionate increase in the input, right? We discussed it is said to be increasing returns to scale. It means when we double the inputs, the output will be more than double. Constant returns to scale. If the proportionate increase in the output and proportionate increase in the input are same, it is said to be constant returns to scale. It means when we double the inputs and outputs also will be double. There are no causes for constant returns. It is just an indicator for ending or increasing returns and commencement of diminishing returns. Next is what? Diminishing returns to scale. If the proportionate increase in the output is less than the proportionate increase in the input, it is said to be diminishing returns. It means when we double the inputs, the output will be less than double. So what can be the causes of diminishing returns? What means the diminishing returns? Inputs are more and output from that input we are getting less in comparison to that increase, right? The increase in the output is less. So what can be there might be some problems in that organization, like proper management is not done, proper coordination is not there, or the raw material that they are bringing in is at a very high cost, so the cost is increasing, the cost of input is more, so the output we are not getting that sufficient increase in the output. So that may be the reasons for diminishing returns. See, they are saying rise of price of inputs, lack of cooperation and coordination, management problems and diseconomies of scale, limit of human factor, right? There are some problems in the organization, proper management, proper cooperation, proper support is not there, the raw material that they are bringing is at a very huge cost, so that are the reasons for diminishing returns, right? And what can be the reasons for increasing returns? Everything is favorable, right? In case of increasing returns, we are bringing, like what DMart does. You have any idea of DMart? You get very cheap, most things are cheap at DMart, right guys? If you go to DMart compared to other malls or compared to other malls, the items that we get are mostly cheap. So what can be the reason? That because they are bringing that proper cooperation is there, proper management is there, the material that they are bringing is directly from the wholesaler and that they are taking in huge quantities, the inventory level is proper, right? So that are the reasons that DMart is able to provide cheap, at a cheap rate compared to others. So it is getting increasing returns, right? So they are saying, see, volume discounts, they are taking they purchase in huge quantities, so they get volume discounts. They negotiate with that specific person and they get volume discounts. So indivisible factor, specialization or division of labor. Means if the labor is very specialized or skilled labor, we will get more productivity, right? So these are the reasons for increasing returns to scale. Now we will discuss the difference between law of variable proportion and law of returns to scale. What are the basic differences? Piyush, you can tell me what are the basic 1 to 2 differences between law of variable proportion and returns to scale? Or Siley? Simple, right? We discussed short run, long run, right? In this only one factor is variable, others are constant. Here everything is variable, right? All factors of inputs are variable. Now what is happening in the returns to scale? We have scale of production, right? Because all factors are variable, it is scale of production in huge quantities. Here there is no scale of production. And what happens to the factor ratio? Factor ratio, no? Factor input ratio, how much quantity of labor, how much units of land we employed to produce 1 unit. That is the factor ratio. So this is clear, right? Short run, long run. One factor variable, other factors constant. Here everything is variable. Scale of production is here because we are in the long run. Every factor is changing. Input factor is changing. So the scale of production here is high. And here there is no such scale of production. Now we will discuss what is the difference between the factor ratio. 3 differences we discussed, right? Clear, Piyush and Saili? Why is she sleeping? You got the 3 differences. Now we will discuss the 4th difference of the factor ratio. So factor ratio is what? See, in the law of variable proportion, what we saw, land and labor. Land remains constant, right? All other factors are constant and labor will be changing. In that example we saw. So labor 1 unit if it is at the start, and labor 2 units and land 1 unit. So previously what was the ratio? Piyush, Saili, what is the ratio? Labor will be changing, land is fixed. At the start we employed 1 unit of land and 2 units of labor. Ratio is 1:2. Now what? Variable factor, labor will be changing, land will be fixed. So what will be the ratio? Land is fixed, so 1 remains 1 and the labor will become 4. Suppose it is doubled. So is the factor ratio changing or is it fixed? The factor ratio is changing here. And now in the law of returns to scale, same, if we have land and labor, previously it was 1:2. Now it became 2:4. So the 2:4, if we make it, will it again become 1:2, right? 2 ones are 2, 2 twos are 4, you know maths. In the ratio, again what the ratio remains? The 1:2. So the previous ratio was 1:2. Now also the ratio is 1:2. So in the law of returns to scale, the factor ratio remains constant, and in the law of variable proportion, the factor ratio goes on changing. Factor ratio of what? The factor ratio of the inputs, right? Clear on this 4 differences? Now we will read these differences. Distinction between returns to a variable factor and returns to scale. The main differences between returns to variable factor and returns to scale are indicated below. Is this the Teams work? Operates in the short run, or it is called short run production function. Operates in the long run, or it is called long run production function. Next, what? Only the quantities of a variable factor will vary. Like one input factor will vary, others will remain constant. Page number 52. Shraddha Kothekar, page number 52. You can see on the screen page number 52. All factor inputs are varied in the same factor proportion. What we saw? All factors of inputs are variable, that is every factor will change, right? Now what it is? There is a change in the factor proportion. Suppose we have 1 acre of land, 1 labor is employed, then the land labor ratio is 1:1. Now if we add 1 more unit of labor on 1 acre of land, the land labor ratio will become 1:2. We discussed, right? What, Piyush? Screen has got freezed, you are not able to see. Now, we discussed right here, they have taken a different ratio. What ratio we took? Land is 1 acre of land and 2 units of labor, 1:2. Labor, 1 unit is variable, labor is variable, so labor will change, land will remain the same. 1 acre of land again remained 1, so labor changed to 2 to 4, 1:4. The ratio is changing, factor ratio, right? Next example here, what will happen? The factor ratio will remain the same. What we saw, 1:2 was the land labor ratio. Now land doubled, labor also doubled. 2:4. The ratio remain again same, 1:2. The original ratio, factor ratio is constant. There is no change in that ratio, right? There is no change in the factor ratio. For instance, if the firm is employing 1 unit of labor and 2 units of capital, then the labor capital ratio is 1:2. Now, if the firm increases its scale of operation and employed 2 units of labor and 4 units of capital, the labor capital ratio still remains the same as 1:2. Now, what fourth we discuss, scale of production. No change in the scale of production because here all factor inputs are not changed. There is a change in the scale of production because here factor inputs are changed in the same proportion. Your the screen is not clear or what? What? Fan, okay. This is clear on the law of variable proportion and returns to scale the differences. Okay. Now, screen. What is production function? Production function, what it will show? It will show the functional relationship between the factor inputs and the output at a given level of technology. See, what if I have 4, 5 inputs, 3, 4, 5 inputs are the land, labor, capital, other entrepreneur. I have 1, 2, 3, 4 inputs, technology. So, what if this I employ, or if these inputs are employed in the production process at a given level of technology, how much output I will get, that it is showing by the production function. Like I will get 10,000 units if I employ a certain level of technology and 5 inputs. So that is the production function. See here, what it is showing, QX is the quantity of units produced. When is a function of F1, factor input 1, factor input 2, factor input 3, all the factor. If there are 5 factor inputs, F5 till F5. If there are 6 till F6, Fn it is given here. So, and A, what is A here? A is a given level of technology that we are using. Particular technology that we will be using to convert these raw materials into finished goods. Clear on the production function? It is nothing but a simple relationship between the factor inputs and the output that we are getting, and there is some certain level of technology that we are using to produce that output. What they are saying? Production function. Production function expresses the relationship between the physical inputs and physical output of a firm for a given state of technology. The production function is purely technical relation that connects factor inputs and outputs. The production function can be written as what? Say simple. QX, quantity of X commodity produced, is a function of factor input 1, factor input 2, factor input 3 till factor inputs n, that is total number of factor inputs with a certain level of technology, that is A. A is a state of technology that we are using. What are F1, F2 till Fn? What did you say, Siley? Factors of production. What can they be? Land, labor, capital, right? And QX is the quantity of product X, right? Clear on this? They are saying the same here. And what is A? Particular level of technology that we are using to produce this, convert these factor inputs into finished goods. where A is the efficiency parameter which reflects the change in the technology. If technology improves, the value of A increases, and with the same amount of input, it will be possible for the producer to produce more output, right? What happens if we have more advanced technology? What we saw in the PPC curve, if the PPC curve shifts towards right, what happens? Economic growth. Why does it happen? Due to technological advancements, right? Because the raw material or the inputs that we will be producing are scarce. We will have 10 only. With the same amount of inputs, the output is increasing. That is, PPC curve shifts right, means what happens? The amount of both butter and guns production will increase. Output increases with the same level of input. This happens due to technological advancements. So that only they are seeing. Where A is the efficiency parameter which reflects the change in the technology. If the technology improves, value of A increases with the same amount of input. It will be possible for the producer to produce more output, right? Piyush, got it? If technological advancements are there, the amount of input, even though they remain the same, the output will, what will happen to output, Piyush? Here, Qx is the quantity of X commodity. F1, F2, F3, Fn are different factor inputs. This equation tells that the output of X depends on the factor F1, F2, F3 till Fn. There is a functional relationship between factor inputs and the amount of goods X. What does this mean? Functional relationship. See, if we increase the amount of inputs, what will happen to the output? Will the output increase or decrease? So is it directly proportionate or inversely? So the functional relationship is that they are proportionately related, right? Types of production function. Before analyzing the types of production function, it will be useful to understand the meaning of the following important terms. Short period production function and long period production. So we saw what is a production function, right? Piyush, can you tell me what is a production function? Short, quickly. Production of a particular product in quantities, Qx, what it is a function of Fn, F1, F2, F3 number of factors, inputs with a given certain level of technology, which is A, right? Clear? We saw what is production function. Now we will see what are different types. Production function can be in a short run, in a long run, right? So what happens in short run? For a short period, we have different types of costs, right? Fixed cost, variable cost. So in the short run, fixed cost will be there, fixed cost and variable cost will be there, or only variable cost will be there. See, in the short run, what will happen in the short run? Suppose for a period of 1 year, and long run for a period of 15 years. So in the short run, I want to produce something. So I will invest capital, bring machinery, building, and then I will start the production of goods. So I will bring machinery, building, then I will purchase the raw material, I will pay the laborer, I will pay the rent. Okay. So in the short run, we will have machinery, buildings also. So we have fixed cost, right? And what are variable costs? Raw material costs, labor, rent are variable costs, right? So we have both variable cost and fixed cost in the short run. But what happens in the long run is, All costs are variable. What we will do, already we have purchased this machinery building, right? So as in the long run, what happens? The scale of production is large, right? So we will be recovering this machinery and building cost also. So they are saying that all costs are variable. Got it? Scale of production in the long run is large, right? We discussed. So we are at a conclusion like in short run, we have two costs, fixed cost and variable cost. But in long run, all the costs are variable. What are fixed costs, variable costs in example, Siley? Both. Building. What? Building. And variable costs are what? So what we can conclude that fixed cost is a cost which remains fixed during the production process for a duration. Variable cost is the cost that varies with the level of output. If we increase the level of output, the variable cost will increase. If output level is decreased, variable cost will decrease. So variable cost will vary according to the output level, right? And will be variable, that it is variable. And fixed cost, it will remain the same. Even if we increase the output decreases, fixed cost remains fixed. And for a longer duration, see, even if the output is zero, what will happen to the fixed cost? Will fixed cost become zero? No, it is fixed. If it is 1 lakh rupees, even if we don't, see, take an example. I have brought building machinery to produce something, but there happens a fire or there is some problem and I am able to produce only 0 units. I am not able to produce due to some obstacles. Either I am not getting the raw material or there is some earthquake or there is fire at my place where I am able to produce. So for 1 or 2 days, I was able to produce only 0 output, 0 level of quantity of my product X. So will the fixed cost be 0? No, the fixed cost will remain the same. Here the variable cost will change with the output. The output is produced as 0, so the variable cost will again be 0, right? So you got to know what are the examples of fixed cost, variable cost. You got to know what is fixed cost, variable cost. You got to know in the short run there are two types of costs, fixed cost and variable cost, but in the long run we only have variable cost. Quick summary. See, we will read this now. Factors of production in the short period can be divided into two types. Fixed factors, variable factors. Fixed factors. The factors which are not available in the short period, they are kept as constant. So they are called fixed factors. Land, building, machines. Variable factors. The factors which are available to change the output in the short run, that is capital, labor, raw material. Long period production function. It explains the relationship between production and factors of production in the long period. It is called as law of returns to scale. Here the production system is guided by the law of returns to scale. The classification of fixed cost and variable cost is only related to short period. We discussed, right? Short period has fixed cost, variable cost, but long period only has variable cost. But in the long period, all factors are variable. This is done now. The clear on the law of variable proportion returns to scale. Can we take a quick break of 5 minutes before moving on to the next topic? Piyush, are you getting clear now? You can ask me anytime if you have doubts. factor is asset, variable factor is liability, by including factors. Hello, Shraddha, can you unmute yourself on Teams, Shraddha? Yeah. Oh, am I audible, Shraddha, now? So what you're saying that fixed factor is an asset and variable factor is liability. Why including factors? I didn't get your question. You mean to say that fixed factor is an asset and variable factor is liability? Shraddha, this is not a genuine statement, right? Every fixed factor is an asset and every variable factor is a liability is not a genuine thing which you are saying. See, what are variable factors? Variable factors are raw material, the rent, the salary which we are paying to the uh, laborers in our organization, the raw material, and what it is more, the rent. So these factors cannot, these are not liability, we can say. This is our expense, operating expense. Liability is like a loan, equity shares, debentures, and short term liability is also what debtors, creditors, right? So we can't say it is our liability. These are our operating expenses, which are variable factors, and fixed factors which are building machinery, but every time they cannot be an asset, right, Shraddha? Building machinery, they are assets, they will be assets, but every time not, because if we are purchasing that building or machinery with our own money, it is an asset. But if we are taking it on a loan or anything like that, we don't consider it as an asset. So it is not a correct statement which you are saying that all fixed factors are asset and all variable factors are liability. Okay, Shraddha, clear on it? Shraddha, can you unmute yourself, please? Okay, okay. Don't make it a fact or a general statement that all fixed factors are asset and all variable factors are liability. Just try to get the concept, what are fixed factors, what are variable factors, what can be their examples, and that. This is the accounting part, but even though what you are saying, it is an accounting part here, it is not a fact or the correct statement which I think. Means it is not a correct statement in the accounting terms also, because they are operating expenses, variable factors. Okay, Shraddha? Should just try to understand the concept of what are fixed factors, what are variable factors, what impact they are bringing on the output, and what are their examples. Okay. हॅलो, बघूयात ना आपण कसं कन्सेप्ट होतात, कसं होतंय, कितपत आपल्याला पोर्शन पण कम्प्लीट झाला पाहिजे ना, नुसतं टाइम बघून नाही चालत, सगळं कन्सेप्ट सगळ्यांना कळले पण पाहिजेत, वेळेत आपलं पोर्शन कम्प्लीट पण झाला पाहिजे, राईट. मला कंटाळा नाही करायचा, शिकायचं ना, मग अजून इच्छा पाहिजे, अजून शिकला मग. किती वाजता असतो? कुठे असतो? इथेच असतो ना. ठीक आहे, बघूयात आपण कितपत मला हे पण आपलं सगळे कन्सेप्ट पण क्लिअर झाले पाहिजेत आणि पोर्शन पण झाला पाहिजे ना आपलं. ओके, विल स्टार्ट. एम आय ऑडिबल ऑन टीम्स? श्रद्धा? हॅलो, Shraddha, can you unmute yourself please and tell me, am I audible on Teams again? So that we can start the next topic.
Yes, ma'am.
Okay, thank you, Shraddha. Now we will be going on the concept of cost of production. So what is the cost of production? You have heard this term, cost of production, right? So whatever cost we incur in producing the finished goods is the cost of production, right? What it may be included: raw material cost, the salary that we pay to the laborers, the rent of the land which we have taken on lease, right? It can be, what other things it can be? Administration expenses which are required, right? Then it can be selling and distribution expenses which are required, right? All these expenses, when we add it up together, will be the cost of production, right? So do you know the difference between cost of goods sold and cost of production? You have studied in your, see 12th you have studied now. There is an gross profit and net profit, right? Recall? Huh. So this is the trading account. And this is profit and loss account, which we prepare in standard 12th, right guys? Everyone has completed 12th. So P&L account. So in this trading account, what type of expenses we have? Wages, cost of raw material, right? So these are operating expenses that we have in this trading account, right? All the operating expenses will be there in the trading account. And P&L account, what? Administration expenses, right? We have. Then we have selling and distribution expenses. Operating expenses are the expenses which are required for the operation of the business, right? For the business to operate. And net P&L we have, which are not directly related but indirectly related to production, are the expenses that we have in the P&L account, right? And here trading, we have the expenses which are directly related in the operation of the operation, or expenses that we take into consideration that are operating expense. So cost of production will include the expenses in the trading account and P&L account both, or only trading account or only P&L account? Any idea? Cost of production. Both the expenses in the trading account as well as the P&L account. But cost of goods sold, here only the trading account. When we have the revenue, we minus only the operating expenses or the direct expenses or the trading account expenses, we get cost of goods sold. But for cost of production, we will be deducting both of these expenses, the expenses from the trading account and the P&L account. Like we will be deducting both the direct expenses as well as the indirect expenses which we incur in producing the finished goods, right? So clear on the concept of cost of production, all expenses, direct, indirect, required for converting the raw material into finished goods are the expenses which we include in the cost of production, right? Cost of production. Cost of production refers to the total cost. Direct cost, indirect cost. Total cost is what type of cost? Costs are of two types, direct and indirect. So total means direct cost plus indirect cost incurred by a business to produce a specific quantity of a product or offer a service. Production costs may include things such as labor, raw material or consumable supplies. In economics, the cost of production is defined as the expenditure incurred to obtain the factors of production such as labor, land, capital that are needed in the production process of the product. Now we saw what is cost of production, right? Clear on the concept of cost of production? Direct cost and indirect cost both will be included. You recall that in the trading account direct expenses and in the P&L account indirect expenses, operating expenses. So now we will discuss the different types of cost. So there are some types of cost. Real cost. So what is a real cost? Any idea? Real cost. You know the opportunity cost you might have heard about, right? Opportunity cost. So real cost is a bit new term which you will all will be hearing. So real cost is the cost of efforts, sacrifices or pain in producing the finished goods. So if you are giving your foundation exam, the efforts or the sacrifice that you have made to sacrifice is what? Not watching TV, not going to any function, like avoiding functions. That is the sacrifice that you have made, right? Efforts are the efforts that you will study every day, 5-6 hours at least, dividing it into 4 subjects, 1 hour each for every subject, right? So these efforts and sacrifices are the cost which they are saying is a real cost. But are you able to measure these sacrifices and costs that you have made? No. So precisely real cost is a cost which is not able to be measured, which cannot be measured in monetary terms, or which is not a genuine cost which cannot at all be measured. If it is not able to be measured, is it that useful in economic terms? Anything which can be measured will be more like we can quantify it, analyze it. But real cost is not measured. Is it quantifiable or can we analyze it? Like efforts were more or less, or sacrifices were more or less. We are not able to measure it. So can we quantify that? Will it be more helpful to us? Real cost? Siley? We are not able to measure it. So it is not that helpful to us in economic terms, right? Because we are not able to measure it. We are not able to quantify it. If we are not able to quantify it, we are not able to analyze it, right? So that's the problem with real cost. So we will see what they are saying here in the real cost. The concept of real cost was introduced by Alfred Marshall. Exertion of all kinds of labor that are already indirectly involved in the production process. All these efforts and sacrifices together will be called as real cost of production. For example, exertion of all kinds of labor, waiting and sacrifices required for saving the capital. But they have not discussed it here, like real cost is not measurable. It is not measurable. We cannot measure the efforts, the sacrifices that you have made to clear the foundation exam, right? So if we cannot measure it, is it useful in economic terms to make decisions? Will that be useful? We are not able to quantify it, not able to analyze it, not able to measure it. So it is not that useful in economics terms to make decisions, right? Now, second cost is economic cost. So, see. So, what is economic cost? Have you heard about economic cost in 12th standard? Have you? Any one of you? Saili, Piyush, heard about economic cost? No. Okay. So, economic cost, clear this, no? Is what? Explicit cost. Yes, who is this? Shraddha. A question. So Shraddha is asking us on Teams, is economic cost and expense? Saili, Piyush, what do you think? I'm replying her. What do you think, Saili, Piyush? Is economic cost and expense? What do you think? It is a cost. So will it be expense? So economic cost is an expense. So why I'm saying she wants to analyze in everything in accounting terms. We are studying economics, right? So first clear the concept of what is economic cost, what are its Indian, then try to analyze it in accounting terms. First only if you try to analyze it in accounting terms, then it will be a bit difficult, right? First get to know what is the concept, and then you will logically get to know whether it is an expense or whether it is a whatever, it can be an expense or a revenue or income. Okay, so left the page where it is. See, we were discussing economic cost. So what is economic cost? Economic cost is explicit cost plus implicit cost economic cost is explicit cost plus implicit cost plus normal profit. So now we will be discussing what are implicit costs, what are explicit costs, what is normal profit. But in an overall term, an economic cost is the aggregation of explicit cost, implicit cost and normal profits. Now we will see what are explicit costs. So guys, what are explicit costs? Any idea? Saili? No. Okay. So explicit costs are the costs which are directly borne or which payments are made by the organization which are directly related in the operation of the business. See, like the cost of raw material. It is an explicit cost directly related to the production and the payment we will be making. Right? Next, what is salary to the laborer? It is an explicit cost. Another rent of the land that we have taken to produce the finished goods. It is an explicit cost.
So what we can say, explicit costs are the costs which are recorded in the books of accounts. We will record these all the costs in the books of accounts, which will be recorded in accounting terms, right? So explicit costs are the costs which are directly related to the production of the business, which payments are made, which are recorded in the books of accounts in the accounting terms. Like, we take them into consideration for accounting purpose, right? So we will read this. Explicit cost. Actual payments made by a firm for purchasing or hiring resources are called explicit costs. These costs are actual money expenses directly. We saw it? Directly. That is operating. Incurred for purchasing the resources, for example, rent to the land, wages to the laborer, expenditure of raw material, interest on borrowed money. Clear on the concept of explicit cost? Implicit costs. So implicit costs are the imputed costs. Suppose I am an entrepreneur. I want to start a business. I invested some capital to start the business. So the business is going on well, everything is fine. I am selling the goods, I get profit. So out of that profit, I have invested some capital. Will I get the interest on that capital as an entrepreneur? If I invest my own capital, not by the outside person. I am saying if I am the entrepreneur, the capital is also mine. If the entrepreneur and the capital are of the same person, he gets some profit. Will he get the interest on that capital? In accounting books, do we record interest on capital if the capital is of the same person, of the entrepreneur? Piyush is saying right. What were you saying, Piyush? No, right? Ha. If the capital is of an outside person, in case of debentures, then we will pay the interest if it is of an outside person. But if it is my own capital, I am only the entrepreneur, I invest capital in the business gets profit, I will not be getting that interest on that capital. In accounting terms, we do not record that interest on the capital, right? So that type of costs are known as implicit costs, which are imputed costs. It is a cost to the entrepreneur, right? But in accounting terms, we are not considering it and it is not recorded in the books of accounts. So such types of costs are known as implicit costs. Okay? Implicit costs. These costs are imputed costs of the factors of production owned by the producer himself, which are generally left out in the calculation of expenses of the firm. We don't consider them in calculating the expenses of the firm. For example, rent for the own land, interest on own capital, right? So what are the, Sally, can you tell me what are the two differences between explicit cost and implicit cost? I will help you. You just tell what you understand. Explicit costs are the costs which are directly related to the operation of the business. Payment is made, but they are recorded in the books of accounts, right? They are considered for the accounting purpose. What are explicit costs? Raw material purchase, salary to the laborer. What are implicit costs? Now tell me implicit cost. I told you explicit. Imputed costs, right? Example, I give you. If I am an entrepreneur, I invest my own capital into the business, I will not get that interest on that capital, right? So that expense is an expense to the expense, but it is not considered. So, and what are the main difference between implicit cost and explicit cost? Explicit costs are considered for accounting purposes, recorded in the books of accounts, but implicit costs are not recorded in the books of accounts, not considered for the accounting purposes. Clear, Sally, now? Normal profit. What is normal profit? Abnormal profit? 2 minutes, guys. You are clear on implicit cost, explicit cost? Business to survive, right? Minimum amount of profit that the business should get. That is a normal profit. Piyush, you are clear on implicit, explicit? We will see normal profit now. So normal profit is the profit at a certain level of output. See, suppose if I am producing 10,000 units of output, I have a certain cost and a certain price. Minimum I should get 1,000 rupees out of that. So at that level of output, the firm expects a certain level of profit. That minimum profit which the firm expects is known as normal profit. And what is economic cost? We were studying what is economic cost. At the start we saw. No. What three aspects are there in economic cost? What three types of costs are included? At the start we saw explicit cost plus implicit cost plus normal cost are economic costs, right? We'll see what is normal profit. The minimum amount which is required to keep an entrepreneur in the production process is known as normal profit. So now clear what are implicit, explicit costs, normal profit and economic costs. Piyush, can you tell me what are economic costs? What three components are there in the economic cost? Plus normal profits. Good. Now we will discuss what are opportunity costs. Everyone might be knowing what are opportunity costs. Or no? No. Okay. So see, opportunity cost is the cost of the alternative forego to get the next best alternative. See, suppose you are doing two courses, CS and CMA. I'm just giving an example. And what you thought like, I am getting very much frustrated. I have to study the two courses. It's a hectic schedule. So what you say, I will forego CS. I'll first complete CMA and later after that I'll complete CS, company secretary. So what did you forego? What did you leave? CS course you left. Now you pursued CMA. So you forgot CS, the opportunity cost of that CS, company secretary course, you forgot, right? So what is the opportunity cost for CMA course? The cost of CS course, right? What you left, what you forgot to get the next best alternative, that is opportunity cost. See, we will again see an example, another example here of opportunity cost. So our concepts will be more clear. See, suppose if there is 1 acre of land. Okay? 1 acre of land. I have an agricultural land. I have 1 acre of agricultural land. So I can produce either rice or wheat on that land. Okay? So if I produce complete 1 acre of land with rice, what is the opportunity cost for rice? The amount of quantity of wheat I did not produce or forego is the opportunity cost for rice, right? And if I don't produce rice, not wheat, if I don't produce rice and I completely produce wheat in 100 quantities, and if, see, we will see that also. Even 1 acre of land, I was able to produce rice of 200 quintals and wheat of 100 quintals. Okay? So, Means what they are giving, 1 acre of land. If I completely use for rice, I can produce 200 quintals of rice. If I don't produce rice, completely produce wheat, I will produce 100 quintals of wheat. Clear on the scenario? Now, if I produce 200 quintals of rice and don't produce any wheat, what is the opportunity cost for rice in quantitative terms? I produce whole 1 acre of land with rice, I get 200 quintals of rice. So what will be the opportunity cost for that 100 quintals of wheat? I have forego to produce 200 quintals of rice. So the opportunity cost for rice is 100 quintals of wheat. If I produce completely wheat, that is I produce 100 quintals of wheat on that 1 acre of land, what is the opportunity cost for that, Piyush? 200 quintals of rice is the opportunity cost for wheat, right? So now if we produce completely rice, completely wheat. Now see, this is 200, 100. What I do? This is rice, this is wheat. What I do is that I produce 80 quintals of rice. What is happening then? I produce 220 quintals of wheat. I take a combination now of both rice and wheat. We saw like only rice 200 quintals, only wheat 100 quintals. Now I am producing combination 80 quintals of rice and 220 quintals of wheat. So what will be the opportunity cost for rice? See, if I decrease rice, wheat quintals of wheat production will increase, right? And if I decrease wheat, quintals of production of rice will increase, right? So they are interdependent with the level of opportunity cost. If I decrease this to 80, I forego 120 here, right? And how the increase here is 120. So if I increase the wheat production to 220 quintals, the opportunity cost for it is 120 quintals of rice. Because I forgone that, right? I will not be producing 120 quintals of rice. I will be producing less rice by 120 quintals rice. Right, Saili? So I forego it. Means I will not be able to do it. Opportunity cost is what? We forego for the next best alternative. I will forego that. I will not be able to produce 120 quintals of rice. So the opportunity cost for 220 quintals of wheat will be 120 quintals of rice. Clear? Now we will discuss this. See, they are shown in this diagram. Rice, they have taken 50. We took different amounts, but they have taken 50. And wheat, they have taken 40. Okay, so what they are saying? Opportunity cost. The opportunity cost of anything is the next best alternative cost which is foregone. Individual point of view or nation point of view, the resources are scarce. At that time, to get one commodity, we have to forego another commodity. Right, Saili? Resources are scarce. We have only 1 acre of land. So, only 1 acre of land, we have to, if we want more wheat, we have to produce less rice. And if we want more rice, we have to produce less wheat. These are called opportunity costs. Suppose a piece of land can be used for growing wheat or rice. If the land is used for growing rice, it is not available for growing wheat, right? Completely what we saw in the case 1. We will completely use it for rice. Then we can't use it for wheat. So how many quintals of wheat we forego? That is the opportunity cost of producing rice. Therefore, the opportunity cost for rice is the wheat crop foregone. Clear? This is illustrated with the help of following diagram. Suppose the farmer uses a piece of land which can produce 50 quintals of rice or 40 quintals of wheat. If the farmer produce 50 quintals of rice, he cannot produce wheat because he is completely using the land for producing that 1 acre. Land is completely used for producing wheat, right? So he cannot produce rice. If he completely uses it for producing rice, he cannot produce wheat. Therefore, the opportunity cost of 50 quintals of rice is 40 quintals of wheat. Here in this example, we saw, right? 1 acre of land, rice 200 quintals, wheat 100 quintals. If I use it for completely for rice, I will forego wheat 100 quintals. So the opportunity cost for rice will be wheat 100 quintals. If I completely use it for wheat, I will not produce rice. So the opportunity cost of wheat is 200 quintals of opportunity rice, right? Clear na, Saili? The farmer can also produce any combination of the true crops on the production possibility curve Mn. Let us assume that the farmer is operating at point A. Okay? They are saying, let's assume if the farmer is operating at point A on the production possibility curve, where he produces OD amount of rice and OC amount of wheat. Okay. OD is the amount of rice and OC is the amount of wheat. Now he decides to operate at point B on the production possibility curve. Now he wants to shift to B. So what is happening? Rice increased from OD to OF, right? What happened? Then what happened? OD decreased from OC to OE, right? You can see on the point B, previously point A, now point B. On previously from OC, it decreased to OE. What? Wheat. Why? Because we increased rice from OD to OF, right? What we saw combination, if we increase one rice, wheat production will decrease. If we increase the production of wheat, the production of rice will decrease. We saw it, right? Here he has to reduce the production of wheat from OC to OE in order to increase the production of rice from OD to OF. It means the opportunity cost of DF amount of rice is the CE amount of wheat. Here we saw, na, like, see, rice, what is the opportunity of cost of producing 220 quintals of wheat here on the screen? We had to forego previously 200 quintals of rice, now 80. We had to forego 120 quintals of rice. So the opportunity cost of producing 220 quintals of wheat on 1 acre of scarce land is 120 quintals of rice, right? We forgoed. Forgoed means what? We could not produce that much. Previously we were producing 200, now 80. So there is a decrease of 120. To increase it to 220, we had to decrease 120, that is we had to forego 120. So the 120 units of quintals of rice will be the opportunity cost for producing 220 quintals of wheat. Applications of opportunity cost. So where this opportunity cost can be utilized or useful? See, if the factor price, determination of factor price. See, if the factor price is less than the opportunity cost, what they are saying, factor price is less than the opportunity cost. Here the opportunity cost was how much in this case? 120 quintals of rice for 220 quintals of wheat, right? Factor price means what, guys? The increase in that factor. Previously the factor was 100, now it became 220. How much was that increase in wheat? Previously wheat we were producing 100, now we were producing 220. How much is the increase? 120. So that is the 120 increase. What is the opportunity cost here of producing 220 quintals of wheat? How much is the opportunity cost of producing 220
of wheat we discussed. How much we forgot? How much we forgot rice? 120 quintals, right? So that is the opportunity cost. Any issue? Ma'am, it means rice increase and demand increase. Opportunity cost. It's calling just a minute. Can we take a just 2 minutes break? I'm getting a call. Saili,
What we were discussing?
Yes. So in this example, see, rice, wheat. Previously, we were producing 200 quintals of rice. Now we are producing 80 quintals. It decreased because why? Because the production of wheat increased to 220 from 100, right? So how much is the change in the wheat? Wheat increased by 120 units. Rice decreased by 120 units. So are the factor price and what is the opportunity cost of wheat here? How much rice we forego? 120 units. So the opportunity cost of wheat is 120 units of rice. So we got the opportunity cost. Now we want the factor price. Factor is that we are producing wheat here. So what is the factor price? It increased by 120 units. So both increases constant. So there is no issue here. But if the factor price, that is the increase in the wheat, was less than the opportunity cost, what we will do is that we will not produce wheat much. We will leave it. We will not increase the wheat. We will not increase the production of wheat. We will divert it to rice or another crop which we can produce. So in short, what they are saying is that if the factor price is less than the opportunity cost, we will quit that factor and use that resource to produce another best alternative. Clear? So what is economic rent here? Economic rent, they are saying factors actual earning minus the opportunity cost. What she is saying, Shraddha, just a minute. See, what Shraddha is saying here, Piyush, Saili and what's her name?
It means rice increases and demand is increased is opportunity cost. Means rice increases, demand increased is opportunity.
Shraddha, see here, hello. Can you unmute yourself, Shraddha?
Yes, ma'am.
See, what is your question? You mean to say that if rice increases, there is an increase in the opportunity cost? I
Yes.
didn't get your question clearly. Can you repeat the question, please, by speaking so that it will be clear to me? Hello?
Ma'am,
Yes.
okay, ma'am.
Yes,
Ma'am,
Shraddha.
increase.
Hello?
Hello, ma'am. Are you listen? Hear me?
I cannot hear you clearly, Shraddha. Could you please be a bit clear and loud? Hello.
Ma'am, I mean, rice is increase and demand is increase. This is a opportunity of cost opportunity.
You want the concept of opportunity cost, right?
Yes.
I'll tell you that. You're not able to clearly. See, Shraddha, if I have 1 acre of land, okay, 1 acre of agricultural land, which is a scarce resource. I cannot increase it. I only have 1 acre of land, okay? So, in that 1 acre of land, I can produce 100 quintals of rice and 200 quintals of wheat. See, I will again explain you. Pay attention carefully, Shraddha. I am explaining it again. I have 1 acre of land. I am writing here, okay, which is a scarce resource, okay? If I use this complete 1 acre of land to produce rice, I can produce 100 quintals, okay? Okay, Shraddha?
Okay. Yes, ma'am.
And if I don't produce rice, completely produce wheat, I can produce 200 quintals of wheat, okay?
200.
Clear on this scenario,
Yes.
Shraddha? Hello?
Yes, ma'am. Clear.
Now,
Yes, ma'am. Clear.
Now wait, Shraddha, I will ask you one question. See, if I don't produce rice and completely produce 200 quintals of wheat, what will be the opportunity cost of wheat? 200 quintals of wheat, this.
Opportunity.
Rice, right? 100 quintals of rice I forgot. I did not produce 100 quintals of rice to produce 200 quintals of wheat. So the opportunity cost of wheat completely producing on 1 acre I am producing wheat, right? Right, Shraddha? Hello?
Ma'am.
Hello?
Right, ma'am.
So
Hello.
what, can you tell me what is the opportunity cost of wheat on 1 acre of land?
Ma'am, increase the width of 1 acre land.
What? I didn't get
Increase
you.
the. Ma'am, increase the width of 1 acre land.
1 acre land is same. I just want the opportunity cost of producing wheat on that land. What I have foregone, what I did not produce. If I produce 200 quintals of wheat, what did I not produce? I have crossed it. Now I have not produced what? Rice, right? Right, Shraddha?
Yes.
For producing 200 quintals of wheat, I did not use this 1 acre land to produce rice, right?
Right, ma'am.
So the opportunity cost of producing wheat 200 quintal is rice 100 quintals. Got it?
Yes, ma'am. Got it. I understand, ma'am.
And suppose if I produce rice 100 quintals, so what is the opportunity cost of rice 100 quintals, Shraddha? What I did not produce now in the next case too. For producing rice 100 quintals, what I did not produce on that 1 acre of land, Shraddha?
Wheat not produce.
Wheat 200 quintals I did not produce. So what is the opportunity cost of rice of 100 quintal? You told me now, wheat, right? Rice I produce. Because I produced rice, I did not produce wheat on that 1 acre of land. So what is the opportunity cost of rice? Wheat 200 quintals, right?
Right, ma'am.
Now clear on the opportunity cost concept?
Yes, ma'am. I clear the concept. opportunity cost.
Now, any other doubt, Shraddha?
No, ma'am.
Okay. Can we move forward?
Thank you.
Yes. Okay. Yeah. So, Sally, what we were discussing? We were discussing what is the economic rent, right? So, the economic rent is the actual earning of that factor minus the opportunity cost. And what is the first one we discussed? Determination of factor price. If the factor price is less than the opportunity cost of the factor, we will quit that factor and we will use it to produce other alternative factor, other alternative option, right? Now, where others this opportunity cost can be useful? It can be useful to a producer. It can be useful. How it can be useful to a producer? See, as a producer, I am producing two quantities. Suppose if how much I forego of quantity 1 to produce another quantity, that is the opportunity cost for another quantity. And if I forego quantity of B product, how much increase in product A I will get, that is the opportunity cost, right? So what we will see as a producer, if I am a producer, if I am foregoing more to produce B, opportunity cost is more, right? So what we will see, opportunity cost should be less than the factor which we are producing. I should forego less, right? See, they have saying here, decisions regarding production plan. With the given resources and technology, if a producer decides to produce greater amount of one commodity, he has to sacrifice another commodity. We saw in case of rice and wheat, right? On 1 acre of land, if I increase the rice production, I have to reduce the production of wheat. Decisions regarding consumption pattern. Same here. If I have 10,000 rupees and I want to buy two commodities, if I want to buy more of B quantity, I have to reduce the consumption of A quantity, right? That only they are saying. The concept of opportunity cost suggests with the given money income. If a consumer chooses to have more of one thing, he has to have more of another thing. Hence, with the help of opportunity cost, he decides the consumption pattern, that is, which goods should be produced in what quantities. Decisions regarding national priorities. Nation also has some scarce resources, right? It also has to decide which of the products it has to produce, which it has not to produce. So, opportunity cost again, if it has scarce resources, if it increases production of one good in one nation, scarce, it cannot produce another much, right? Because resources are scarce. That also for nation is applicable. If a country decides that more resources will be devoted to arm production, what will happen? Other production which we are making will be less produced, right? Then less will be available to produce civilian goods. In this situation, a choice will have to be made between arms production and civilian goods. The concept of opportunity cost helps in making such choices. Now I'll erase this everything. What happened? Shraddha, today, what she saying? Hello? Shraddha? Can you unmute?
ma'am.
Any other doubt on the opportunity cost? You were asking something, but I did not get that clearly what you were saying. Any other doubt? Till I am erasing it, you can tell me. Can
No,
you?
ma'am.
No, no? Okay.
No doubt. Okay. Thank you.
Siley, Piyush, clear up till now? Any doubt? I am like a friend. You can ask me anytime, right? Now we will be moving on to the concept of short run and long run cost. And erase this, it is already marked too much. They are right. Siley, that one, others are not coming. Why? Are they attending through Teams? तिला विचार, तिला माहित असेल. Short run and long run cost. So what we saw previously in the short run, there are two types of costs in the short run. Which type of cost we were seeing? Fixed and variable cost. And in the long run, all costs are variable, right? And in the long run, the scale of production increases, right? But as compared to in the long run. So what they are saying is that short run and long run costs. Same they are saying. Short run is a certain period of production where the firm's one input of production is fixed while others are variable. The short run does not specify the extent of time. There is no specific time duration like 12 months is short run or 6 months is short run. But what they are saying, but rather unique to a firm industry. Every firm, every industry for a short run will be different period of time and different duration, right? During the short period, the firm faces both fixed and variable costs. Piyush, right? During the long run, which type of costs? All costs are? काय काय काय? प्रायव्हेट घेऊयात आपण, एवढं कंप्लीट करू आता. आता हे चालू केलं ना, घेऊयात. Piyush. So in the long run, all costs are? Which costs? Variable. And in the short run, Piyush? Fixed and variable costs, both are there, right? So they are saying same. During the short period, the firm faces both fixed and variable costs. It differs in the long run. During the long period, all factors of production and costs are involved in the production are variable. During this form, a firm can adjust its costs. So what they are saying is that in the long run, the total cost of production is the minimum cost of production that the firm incurs at a certain level of output. See, in the long run, in a business, naturally a business will not think of a short run, right? It will think of long run, operating in the long run. So in the long run, where the objective of the business is the same, it wants to operate for a long run. What they are saying is that at a certain level of output, if the level of output or the quantity produced is 10,000 units, the total cost of production is the minimum cost of production to produce these 10,000 units of output. What did you get, Piyush, from this? What did you understood? Did not understand. See, what is the will the business operate in the short run or long run? First tell me. You brought machinery, you purchased building. So what will be your objective, to produce for a short run or to produce for a long run? First for a long run. So what they are saying, in the long run, what happens if the business produces 10,000 units, suppose, that total cost which we will be calculating in the long run is the minimum cost of producing that 10,000 units. Minimum means the least cost. Okay, clear? See, Saili, you are clear? Long run, total cost refers to the minimum cost of production. It is the least cost of producing a given level of output. Here, what level of output we took? 10,000 as hypothetical, right? At 10,000, if we in the long run, if we are producing 10,000 units, the total cost of production in the long run will be the minimum cost that we will be required, least cost we will require to produce that 10,000 units, right? Okay. Now she was saying what is private cost and social cost, right? So private cost is, see, what are private companies, you know? You know what are private organizations? Though organizations which don't work for the welfare but want to maximize profit are private, what we say. Their main objective is to maximize profit. And what social or public organizations is that they, at a reasonable price, they want to provide that commodity to the public. That are public or social organizations, right? You got the difference between private and public? See, so what is private organizations may happen in case of producing units, they may do some things which are not socially correct. See, suppose I am a private organization, I am producing something and there is some chemical which it is released during that process. If I directly bring that chemical out of my manufacturing factory and that chemical directly goes into the river nearby the factory, so is it a right thing, guys? No, right? So these things, ideally what should happen? The company should some chemical, if it is releasing into the river, it should ideally clean up that much, it becomes less toxic, and then it should release that into the river so that the fish, the species in that river do not get harmed, right? And the water there also does not become that toxic, right? And otherwise it will create a harmful impacts on the environment, right? So the private costs are that cost we are saying. Normally the private organizations incur that cost plus whatever the marginal they incur to convert it into that are private costs. They have to convert that. See, if that chemical is toxic to the environment, it is not a right thing. We have certain social responsibility towards the environment also, right? We can't do anything because we want to maximize our profit and for our own benefit, right? And what public organizations or social impact happens here is that when the government takes into consideration, like, see, another example we can take. We are releasing we are producing goods, and after that we release certain chemical into the air. So what happens is that these organizations, the chimney that we have in these organizations is tall enough, right? Why? Because that polluted substance which we are releasing during the production process should go out
in the not if we don't have the tall height of that chimney which is releasing that, what will happen? Less height, it will get polluted in the air. Human beings will get affected. When it is at a tall height, it does not come much towards the human intervention, right? So that's why. So these are the social responsibilities that we have to take into consideration as an organization. We just can't maximize our profits, right? And do anything unethical or anything which is not right to the environment or to the welfare of the human beings, right? So what they are saying is that in order to maximize the social welfare, the social marginal cost has to be equated to the marginal revenue. In other words, this equality of marginal revenue and social marginal cost also ensures the most efficient allocation of resources. So what are the cost curves? In the short run, what will happen to the scale of production? Will the scale, we were discussing law of variable proportion and returns to scale. So where the scale, there are scale returns or the scale of production changes in which law? Returns to scale, right? Because every input factor changes, right? All factors are variable, right? So in the short run, what happens? The scale of production does not change, as we saw in the law of variable proportion, right, Piyush? And in the long run, that is the law of returns to scale, the scale of production changes. So if the scale of production changes, what will happen to the, what is the cost curves we are discussing? What will happen to the cost curve? Scale of production is changing. Cost curve will again keep on increasing, decreasing, right? Right, Piyush? So we are discussing the short run average cost. What is the short run average cost? What will be short run average cost? Short run average cost. You know average cost? We discussed what is average cost? Total cost divided by what, Piyush? The variable component which is there, that we will divide it. We saw in the previous lecture, right? That is average cost. So what is short run average cost? Average cost that the organization incurs in the short run divided by the variable factor in the short run, right? Right, Saili? And what are the long-term average cost? What are long-term average cost? Total cost which is incurred in the long term by the organization divided by the all the total of variable factors which in the long run, right? Clear on average, short run average cost and long run average cost? What is her name? Ashwini, clear on short run average cost, long run average cost. Now we will see what impact it brings. See what we saw in the short run, is the scale of production constant or the scale of production changes? In the long run, we saw, right, law of variable proportion, returns to scale. In returns to scale, all input factors are that are variable, they vary. So the scale of production increases because the input factors increase. Input factor and output are directly proportional. We saw, right? So if the input factor increase in large quantity, large scale, the output factors will also in the long run increase on a large scale. So the scale of production in the law of returns to scale is there. But in the law of variable proportion, there is no scale of production. So similarly, in the short run, there is, in the long run, we have scale of production, but in the short run, we do not have much scale of production, or we don't have scale of production. So they are saying the same. In the short period, the firm has fixed scale of production. One short run average curve is corresponding to the particular scale of plant. So the scale of production is same, means we were producing 10,000 units, we will be producing 10,000 units. Scale of production remains the same. So the short run average curve which is there, what they are saying is also at a same scale, right? Is corresponding to a particular scale of the plant. So in the short run, firm can operate on a particular scale of plant, right? But in the long run, the firm chose among possible sizes, or it can move from one scale of production to another scale of production, right? This can be shown with the following diagram. See, at this short-term average cost, the scale of production is same. But for the long run average cost, the scale of production is going on changing. In the above diagram, there are various short-run average costs which correspond to various sizes of plant. These are various sizes. See, first maybe 1,000 units the firm is producing, second maybe 2,000, third maybe 3,000, fourth maybe 4,000. Various scales are there. The long-term average curve will be tangent to each of the short-run average cost curves. It shows the least possible average cost producing quantity of the output when the scale of plant is varied. When we vary the scale of the plant, what is it showing? The least possible average cost. When we increase or what is scale of plant? Piyush, what is the scale of plant? What does it mean? Change in the quantity produced means change in the scale, right? So if we increase or decrease the scale of plant, in the long run, what this curve is showing is the least possible average cost. Means the least possible cost when we increase the units, when we decrease the units. What this is showing? Main points. So what is the total cost? Total fixed cost plus total variable cost will be the total cost, right? Because cost has two components, fixed and variable, right? So the total cost will be the aggregation of total fixed cost plus total variable cost. So we are seeing what it is showing here. Total cost they have given.
Hello.
Hello. Who is speaking?
Ma'am,
Yes, who is this? Can you tell your name?
शैला.
Yes, Shaila.
तिची डायग्राम घेतली मॅडम तुम्ही आता ह्या जे आता दिसतोय तो चार्टच्या वरती.
काय म्हणते तू? मला क्लिअर आवाज नाही येते शैला.
स्क्रीनवर जो चार्ट तुम्ही आता
पेज नंबर नाही दिसत आहे का
एक्सप्लेन.
तुला?
हॅलो.
हा
आता जो स्क्रीनवरती जो चार्ट दिसतोय ना
हा बोल बोल.
त्याच्यावर जी डायग्राम तुम्ही घेतली ना मॅडम,
काय म्हणते ती? त्याच्यावरती काय म्हटलीस तू? क्लिअर आवाज नाही येते अगं.
ती जी डायग्राम घेतली ना तुम्ही वर यू शेपची,
हा
हा तो खाली जो तुम्ही जो चार्ट वगैरे आहे ना ते डायग्राम आहे, पण तो जो चार्ट आहे ना बुक मध्ये वेगळा आहे.
बघू तुझं बुक आणि बघू आपण. माझ्या बुक मध्ये कसं मी नाही बघितलं. म्हणजे असंच आहे का एक्झॅक्टली चेंज? हा पण आहे ना चार्ट, नंतर आहे ना. हा पण आहे, चेंज झालंय का? ओके तो चार्ट जो आहे ना तो त्यांनी 60 पेज वर टाकलाय आणि हा चार्ट इथे टाकलाय. बघितलं मी. माझ्या बुक मध्ये कसं आहे माहिती का, 56 वर हा चार्ट आहे आणि 60 पेज वर हा चार्ट आहे. असंच आहे इथे जसं आहे तसं. आपण हा चार्ट पण घेऊयात, पुढे आहे ना तो चार्ट, त्याचंच एक्सप्लेनेशन आहे ते घेऊयात आपण. क्लिअर होईल ते सुद्धा घेऊयात, ते काही मिस नाही करणार मी शैला. चालेल? काही डाऊट असेल तर हा बोल.
हो प्रॉब्लेम नाही. ते पुढे मागे झालं ना की ते कळत नाही नेमकं तुम्ही कुठे वाचताय असं होतंय.
अगं पण त्याचं जे एक्सप्लेनेशन आहे ना ते काही पुढे मागं नसून ते रेलेव्हंटच दिलेलं असणार आहे त्यांनी. या चार्टसाठी जे एक्सप्लेनेशन आहे ते त्यांचं रेलेव्हंट आहे. फक्त चेंज केला सिक्वेन्स, कन्सेप्ट तोच आहे, काही एवढा फरक नाहीये त्याच्यामध्ये. म्हणजे टोटल कॉस्ट काय असते, टोटल फिक्स्ड कॉस्ट प्लस टोटल व्हेरिएबल कॉस्ट. जसे आउटपुट वाढतं टोटल फिक्स्ड कॉस्ट कॉन्स्टंट राहते आणि व्हेरिएबल कॉस्ट जसं आउटपुट वाढतं तशी व्हेरी होते, इन्क्रीज होते. आउटपुट वाढलं तर ती इन्क्रीज होते, आउटपुट कमी झालं तर ती डिक्रीज होते. म्हणजे टोटल कॉस्ट,
हो
कळालं का तुला? तेच आहे हे, काही वेगळं नाही याच्यात.
हो हो मॅडम, आलं लक्षात.
आलं ना? चालेल, बघूया आता.
हो,
See
चालेल.
what we saw. What is the total cost? As we increase the number of units, what will happen to the total fixed cost? Will it remain fixed or will it increase or will it decrease? Even though we increase the units of output. So total variable cost. If we increase the units of output, will the total variable cost increase, decrease, remain constant? What will happen, Saili? Increase, because the variable cost varies with the number of units or the output produced. When we increase the number of units of output, the total variable cost also increases, right? So they are saying, and what is total cost? Total fixed cost plus total variable cost, right? See, this is shown here in the same way in this chart. They are saying the same thing here. So what is driving the total cost? Total fixed cost or the total variable cost? What is bringing the change in the total cost? Total fixed cost is bringing a change or total variable cost? Because fixed cost is remaining constant. If the variable cost is increasing, the total cost is increasing. Fixed cost is constant, right? If variable cost increases, then only the total cost is increasing. So the total cost, the driving factor is total variable cost. Clear, Saili? See, the same here. What was speaking? Shaila, see, if the output is 0, as we increase the output, what is happening? Total fixed cost will always remain fixed irrespective of the outputs produced. Even if we produce 0 output, there will be fixed cost. And even if we increase the number of outputs, the fixed cost will remain constant, that is fixed. Total variable cost. If we don't produce any output, there will be no variable cost, right? As we increase the units of output, the variable cost will also increase. And the total cost is a summation of total fixed cost plus total variable cost. What is driving the total cost? Since the fixed cost, total fixed cost remains fixed, the change in the total cost happens due to the change in the variable cost. So the driving factor for the total cost is total variable cost, right? Clear, Shaila? Hello?
Yes, ma'am. Yes, ma'am.
Yes, we'll move forward, Shaila. See this diagram. Figure 1.32. What is in fixed cost is constant. So fixed cost is 20. It is a straight line. It is not increasing, not decreasing. It is remaining constant. So it is parallel to OX axis, OX or X axis. What it is showing, as the total number of units produced or the output is increasing, variable cost is also increasing, because variable cost depends on the number of units of output produced. So, and what is driving the total cost? Variable cost. Total cost will be dependent on the variable cost. So variable cost is increasing, so total cost is also increasing, right? एवढंच घ्यायचं फक्त, हा टेबल मग सोडते. Shraddha, it might be on the next page. Please check it out. On the first side or wherever there, try to check 2-3 pages. It will be there. Or if it is not there, you can see on the screen. We will discuss. You have any doubts? Yes. ते घरी जाऊन रिवाइज करते ना सायली तू. हा इथे वाचलं की घरी जाऊन वाचत जा एकदा फक्त 5-10 मिनिटं फक्त वाचायचं, जास्त नाही वेळ असं ब्रशअप करायचा प्रयत्न करायचा, आठवायचा प्रयत्न करायचा काय शिकवलंय आज, म्हणजे ते फिट बसेल तुमच्या डोक्यात. कळालं? आज गेल्यावर काय 10-15 मिनिटं फक्त बघितलं तर ते एकदम आत्ताच बघितलं ना, आत्ताच आपण केलेलं, त्यामुळे मग ते 10-15 मिनिटं रिवाइज जरी केलं तर एकदम फिक्स बसेल डोक्यात. तसं करायचं. आणि मग कळतं पण ना किती कळलंय किती नाही. मग दुसऱ्या दिवशी डाऊट विचारू शकता तुम्ही काही असेल तर. 10-15 मिनिटं तर देऊ शकता तुम्ही. आता किती 6ला घरी, 6-6:30ला, किती रात्री 10 पर्यंत, तर 10-15 मिनिटं तर काढताच येतील ना.
Hello. So we will be seeing this table. What they are saying, we are having 0 output till 8 units of output we are producing. The output is increasing. Total cost, what it is we saw? Total fixed cost plus total variable cost. So fixed cost is 20, variable cost is 0. 20 plus 0, what will be total cost? 20. So it is 20 here. Okay. Again, see, fixed cost is 20, variable cost is 8. So what will be total total cost, Piyush? Huh? No. See, total. What is total cost? Total fixed cost plus total variable cost is the total cost of the organization. If the total fixed cost is 20, total variable cost is 8, what will be total cost? 20 plus 8 is, we're saying 20. So I said, again we'll take once. Ashwini, you tell me, what is total cost? No, I am just asking, layman term. The total fixed cost plus variable cost. So total fixed cost is 20. Total variable cost is 10. What will be total cost? 20 plus, Ashwini, what? 20 plus, if total variable cost is 14 and total fixed cost is 20, total cost will be total fixed cost plus total variable cost, which is 20 plus 14, which is 34. Clear? So they have done the same thing. What they have done here is, for total cost, they have added up total fixed cost plus total variable cost. You can see here all the figures of total cost are the addition of total fixed cost and total oh, it got hanged. What happened? Why we are not able to see the screen? Unable to connect the entertainment room. Now it is. So what we are seeing, the total cost here, the 20, 28, 34, 38 are what? Addition of total fixed cost plus total variable cost, right? What is average fixed cost? अरे काय होतंय, जाते का स्क्रीन वर का दिसत नाही? Let it be, we will discuss it in the next time. The screen is also creating an issue here. See, the screen mirroring is there, but why it is creating an issue, I'm not able to understand. It's getting hanged or thing. Now it's there, but okay, let it be. We'll discuss it in the next lecture, right? Go home, just try to revise it for 15 minutes, 10-15 minutes. So any doubts you can ask in the next lecture, or anything which is not clear, and you also will get an idea. It will get fit in your mind, right? Okay.